topic is how will the recession impact Latin America, but I think that starts by asking what has Latin America done to make it possibly grow more rapidly in the past few years and perhaps different from the last time. Quite clearly in the last few years commodity prices have boomed, that's been a factor, but most of them have also, I think, been less profligate perhaps in their fiscal policies than they have in earlier booms. They are not yet to a point, except for Chile, where they are in structural surplus, which they should be in times of high commodity prices, but the debt to GDP ratios have fallen somewhat. And in that sense, they are less vulnerable to a downturn. For the most part, I think everybody is projecting that growth will fall somewhat if things turn down in the world economy for very long, but there is, as you know, a big question as to how prolonged the downturn will be, as much as how deep it will be. And with that, there's a question of how much that matters for commodity prices, which seem to have been driven in part by outside the U.S. factors. And that part is big, because if commodity prices are sustained, the impact on Latin American economies should be less for that reason, and it should be less because they're starting from a sounder position than they earlier were. So both of those factors play to arguing for a milder situation. Obviously, if commodity prices fall more sharply, then some countries are more vulnerable than others. But even so, relative to past periods of recession, the vulnerability looks less. People were talking already about last summer about poor Mexico doing worse on account of how the U.S. slowdown and so on. So far, the evidence is the other way around, which I think goes to the point, because Mexico is perhaps more closely tied to the fortunes of the U.S. than any other outside the Caribbean or any other big economy in Latin America. So overall, the outlook, I think, is pretty good. All of them are starting with a much less inflationary situation, which helps also, because that gives them more room for easing if they need to in policies than they've had in earlier downturns. As I said, debt to GDP is still not where one would feel it was totally in the comfort zone everywhere, but it's certainly less than it was. So I think the outlook for Latin America is that if the U.S. just has a mild couple of quarter recessions, or even just slowdown, which seems to be the most likely scenario at the moment, it doesn't seem to me that there'd be more than 1 percentage point impact on Latin American growth, and that mostly because they probably do not have a sustainable 5 or 6% level, which has been the level of the past couple of years. And so to have some slowdown, I think, would have been desirable just on anti-inflationary grounds. The IMF is forecasting 4.4% for 08 and 3.6 for 09, going from 5.6 in 07, which would be almost it would be 2 percentage points down total. That's probably a bigger drop than will happen unless the recession is more severe than now seems to be likely, and unless it spills over into Asia more than seems likely, and those are two unlesses, not one, they're not the same thing. So on both those grounds, I would argue that Latin America's prospects are not that seriously impaired by what's going on in the world economy, unless it turns out to be more severe than we now expect. That said, most Latin American economies, I think, have not done what many would argue they should do if they want to get their growth rates up and to be more competitive with East and South Asia. I think there's disappointment I think there's happiness or satisfaction, if you like, at least to some degree in the macro side, although getting to the point where you had a structural surplus in good times and structural deficit in bad times, and macro would be even better. But they're better off in that way where the macro is vastly improved. On the other hand, the underlying micro is not. There are lots of reforms remaining to be done in most Latin American countries. They differ what they are from country to country. They differ in severity, but they're there. And it's on that issue that I think longer-term growth prospects still depend and are much more important in looking forward as to what's a sustainable rate of growth. I'll stop there.
Okay. I'm glad you covered some of the ground that I was going to cover, so I'll do a little bit less probably. Just a little bit about CBER for those who don't know, because it is relevant to this. We're an independent nonprofit think tank here, and we were the first, my colleague Dean Baker actually was the first to show mathematically that the U.S. stock prices of the 1990s were not compatible with any plausible growth projections for the United States. And then he was also the first to analyze and demonstrate the housing bubble beginning in 2002. In both cases, we predicted that the bursting of the bubbles would cause a recession. And in the first case, 2001, the recession was much milder than we had anticipated because you had this enormous housing bubble that immediately rescued the economy from that one. So just for one premise, I guess, where we will differ is that we think this is going to be a serious recession. So the numbers I'm presenting on Latin America are not a forecast because that depends very much on the effect on movements of the dollar, which are not predictable, very less predictable. But I don't have any problem forecasting that this will be a serious recession in the United States because you have, an $8 trillion housing bubble, which is not even half burst yet. House prices falling at over 25% annual rate right now. And at the peak of the bubble, consumers were borrowing about $800 billion a year against their homes, and that has to stop because they can't do that anymore. So the savings rate is going to increase whether people want to save more or not. And so given all of that, weakness in the labor market, the commercial real estate now falling as well at present, I think this is just beginning, and you're not. It's hard for me to imagine a mild recession or even a sustained recovery until the housing bubble, until house prices return somewhat near to trend levels. So on that basis, we are predicting a serious recession. Now that said, there's still a lot of uncertainty, and so the numbers I'm going to show here are not a forecast because they do depend a lot on what happens to the dollar. Okay, so just to take the basics first, you had, the U.S. was a rapidly growing economy and rapidly growing imports, especially imports increased by more than $1.5 trillion from 1994 to 2007. And however, we developed a huge trade deficit, which peaked at about 6% of GDP, and that is unsustainable. I think most economists recognize that that's unsustainable. So that's going to have to be reduced, and this recession would be a time when you would expect that to happen. So that's going to have an impact on the Western Hemisphere. The countries where you get most effect are those that have a lot of exports as a share of their GDP, and the ones where the exports that they do have have a large share to the United States. So the countries that would be most hard hit by a recession would be the ones that have the so-called free trade agreements with the United States, and these are some of the countries here: Mexico, Guatemala, South Costa Rica, Central America, and the Caribbean in general. And here's a chart. Let's see. Can we see that from here? What do you think? You guys can see that. So, so you can see there's quite a variety in terms of who's impacted most. And we took out, by the way, we took out oil from this, oil and gas. So on the assumption that those won't really be much affected. So Venezuela, for example, you can see as their exports to the U.S. are 15% of GDP, which is quite large, but 95% of that is hydrocarbons, is oil, and so that's not going to be affected very much, as we see. But just to show you, who's most dependent on exports to the U.S., you can see it here, ranging from, here's, we'll leave Canada out, we talk about Latin America, but look at Mexico. 21.4% of GDP is exports to the United States. Nicaragua, 25%. You have Costa Rica, 17%. Dominican Republic, 13%. So these are the El Salvador, 9.6%. These are the countries that would be most immediately affected, and the the ones that are least affected would be countries like Argentina, Brazil. 1.6% of GDP is exports to the U.S. Brazil what is Brazil here? 1.9. So not very much for them. And so that's all that we're saying here. Now, just something on the assumptions. In this low adjustment scenario, we're assuming, the trade deficit has already fallen from its peak of about 6% to 5.2%. That's because, the dollar has fallen against the trade-weighted basket of currencies. Since 2002, it's fallen by about 25%. And so that's part of the adjustment has already taken place. I guess what the United States is going through, in a sense, is a structural adjustment, as it used to be called, and it is, and this is part of what goes on. You have, in our case, since we have a flexible currency, it falls, and this is the adjustment that takes place. We have another scenario which I think is less likely, and that's with the the first scenario is the trade deficit falls from 5.2% of GDP, the current level, to 3.0%. And the second scenario is it falls all the way down to 1.0%. Now this is just based on this idea of what kind of, the first scenario, or both of them, what kind of levels of trade deficit you could have over the long run and be sustainable, even if the foreign debt continues to rise as a percentage of GDP. Now the paper, you'll see that the foreign debt actually in the last few years has not risen for technical reasons, even though we've been running these huge current account deficits, but that's because of the differential valuation of our assets and foreigners' assets in the United States, but that's something that we wouldn't expect to continue. So basically, just in terms of the overall story, we're talking about an adjustment that has to take place at some point in order for the U.S. to just not have an explosive foreign debt as a percentage of our economy. Again, that's why this isn't a forecast, because you don't really know when this is going to happen. But we're suggesting here that part of it, at least, would happen during a serious recession in the United States. So, so here's the overall results in terms of the decline in GDP that you would expect from the narrowing decline in GDP in other countries from the narrowing of the U.S. Trade deficit. That's all this chart shows. And you can see the ones least affected. Again, least affected, Argentina, 0.2% of GDP. Brazil, 0.2% of GDP. You would expect a decline. And then you have others that are much bigger. Mexico, 2.9%. Mexico actually did go into a recession in 2001 during our last recession, which was a very mild one. Honduras, 5.9% loss of GDP. These are quite large, some of them, and Costa Rica, 2.7%. Notice that, again, Venezuela, very little effect at all because their exports are just oil. We took that out. So you can see the overall effect. It really varies by country, but it's significant, and in some cases could even cause a recession, depending, of course, also on the policy response in the various countries. Okay, I won't go through, in the interest of brevity, I won't go through the large decline because you have the paper, you can look at it, but they're proportional, and it's a similar thing. This is just on the assumption that the U.S. trade deficit shrinks quite rapidly. Okay, what's the conclusion? Well, first of all, we will see slower growth, and I think we recognize that as well. It depends, of course, partly on the severity of the recession in the United States, but also on the adjustment in the dollar, which is, somewhat correlated with the growth in the United States, but not necessarily, not completely. Also, the other thing is, I want to emphasize, we're leaving out other channels of transmission of the U.S. slowdown other than trade. So that was just a very narrow look at trade. Remittances are already falling, and those are quite large in some of the economies that we're talking about. I put it in the paper here, just a few of them with that are largely dependent on. That have a big dependency on remittances. Haiti is 31% of their economy, Nicaragua 17%, El Salvador 16%, Jamaica 16%, Guatemala 11%. These are big remittances. I didn't have Mexico in there, but that's significant as well. And the Inter-American Development Bank has already found that so far, with the recession not even officially beginning, the proportion of workers sending remittances home has fallen from about, to Latin America, from the United States has fallen from about 3/4 to 1/2. So 3/4 of workers sending home remittances and then now only half. So this is another big influence. Then there's the financial crisis, the credit crunch, the effect of that on investment flows and interest rates, continued problems in the international financial system. We don't assume any of those. These could, of course, continue as well. There's also the possibility of pro-cyclical policy responses. Brazil is one central bank, for example, that has already responded after a long period of cutting interest rates from a high of 26% on their overnight rate to 11.25. They just, the last couple of weeks ago, they raised from 11.25 to 11.5. Goldman Sachs expects them to go all the way to 14.5. This is a country where, you know, inflation is not much higher than ours, a little over 4%. So very high real interest rates. This could have an impact of other central banks do that as well. Now, as Anne mentioned, I mean, they are in a much better position. They don't necessarily have to do that, but we don't know this. You know, that doesn't mean they won't. Finally, just to mention some long-term trends. I think it'll have an impact on this. You know, you've had a drift away from the United States and Latin America in recent years. I think that will continue because the United States will become, in this period, less economically important as it was. We're not going to have a growing import market like we did in the past. You know, possibly for some time, depending on how the trade deficit adjustment takes place. I think the further free trade agreements are unlikely. I think you're going to see more regional economic integration, more focus on that, and more diverse economic and possibly development strategies. Partly for the reason the United States' influence is waning, and of course there's other reasons which I can go into if you want why the U.S. has lost so much influence over economic policy in Latin America. Let me just put one last slide on here, and then I will stop and make sure we have enough time. This is one. Let's see, let me show this on a slideshow. Yes, okay, there it is. This has showed what happened in Latin America in the last 27 years. You had, you know, reasonable growth from 1960 to 1980, 82% per capita. It wasn't like the Asian countries, but it was enough to have a huge positive impact on living standards. And then you had this crash since then, which hasn't really recovered except the last 3 years, but you can see that even with the last 3 years of growth, reasonable growth, not quite what you had in the old days, but reasonable growth that Anne mentioned, you're still looking at another bad decade and another bad, well, actually 30-year period. Very long, unprecedented growth failure. That's one of the reasons why I think Latin America is moving in another direction. And I think the lessened dependence on the United States, I guess that's the bright spot in the long run, will I think, accelerate this, not this trend, but the trend of more independent and more diverse policies. I'll stop there. And feel free to take some more time if I want longer.
Well, we obviously disagree somewhat on the severity of the recession. And it's certainly true that the housing adjustment is going to take a couple of years. There's no difference between us there. But already it is evident that the reduction in consumer spending, as you pointed out, is helping with increased exports, the exchange rate and all that. And there's been more of an offset that way than I think almost anybody anticipated. And given where the exchange rate is now, I think that's likely to persist at least for several quarters. So, in fact, I think that accounts for part of the mildness so far and will continue to do so. So I don't think we disagree very much except on how much that's likely to spill, number one. Number two, commodity prices are important for Latin America, and they're not driven only by the U.S. or even primarily now by the U.S. Obviously, what's happening in growth in East Asia is important for that, in fact, probably more important. And so far, nobody is forecasting that the East Asian, South Asian growth rates will fall because of what's happening in the U.S. And in fact, as you know, this morning they're even talking food crisis. There's some concern, on the other hand, that maybe growth may be so high that there are other kinds of problems. So I think, in a sense, Latin America is positioned in a place where it's much better insulated vis-a-vis U.S. economic activity than it was, because U.S. economic, in part because U.S. economic activity before did, to a large degree, affect the rest of the world enough to be the driver of commodity prices to a fair extent. And that's much less true now. One can imagine, I think, recession in the U.S. For a year, and nonetheless that does not forecast a drop necessarily in oil prices or in other commodity prices. It might even just slow the rate of increase, and it might. The same as you say could, I say might. But in any event, so in that sense, it seems to be Latin American fortunes are much more dependent on individual countries. The other thing I still think is that the Chilean example is noticed in the rest of Latin America, and other countries are getting stronger and stronger pro-reform groups to get away from some of the growth-negating micro-interventions that have been so prevalent in the past and quite clearly have kept Latin American potential down. How soon that will feed through is an interesting question. I think it already is to some extent in Brazil from the reforms of the 1990s, not that there's that much going on microeconomically now. Brazil does have very high real interest rates, as was mentioned, but they've had them forever. In fact, the real interest rates were higher before than they are now. And Brazil has a huge history of inflation, so that on the one hand, any small increase in price levels there is likely to lead to self-reinforcing expectations to a greater degree than in other countries, so there's that. Finally, on the U.S. current account deficit, I agree that in the long run it's not sustainable, but U.S. debt as a percent of GDP is well below that of most other industrial countries by quite a bit, regardless of whether you take debt held by foreigners or total debt. It is just not in the same ballpark as Japan's 180%. Numbers like that, countries in Europe are fighting with to get below the 60%, et cetera, et cetera. While it's certainly not sustainable in the long run, how rapidly it has to adjust.
This is the foreign debt I was talking about, not the...
Well, that would make my case even stronger, because U.S. domestic debt is stronger than foreign.
No, but I mean, Japan has 180% on their national,
yeah,
not foreign.
Yeah, but 180% is still a very big number, and in terms of what it's going to do to your economy, is much bigger. And most rules of thumb for most of the industrial countries would say that the U.S. level isn't that bad. It's the rate, which you yourself said, but it's the rate at which it's increasing, which is not sustainable, with which everybody agrees. The other interesting thing is that the drop in the current account deficit would have been larger, of course, except for the increase in the oil price. So that in a sense, the exchange rates had more of an impact overall on exports and other imports. It's been the oil price in the sense is, if you take oil out, which I agree is an unfair thing to do, then you get a sharper drop. And should you get into a sufficiently severe recession, as you're suggesting might be possible, then I think you've got to ask what would happen to the price of oil, and if that happened, then you get other things feeding in there, so that the general equilibrium effects, I think, are a little bit larger and perhaps more offsetting than would appear at first glance. So I guess I think that the outlook for Latin America in the long run is not terribly good, and not terribly better than it has been, until they get on with some of the microeconomic reforms that are necessary. But on the other hand, the short-term outlook is not as badly affected by the recession as many people are prone to assume based on what happened in the past.
So, ask away.
I'm interested to hear about what you think, because I know that the appreciation of currencies, if anything, places like Colombia are really a big squeeze on the economy right now. Any thoughts of how that is affecting Latin America?
Well, of course, it's helping keep the inflation rates down. And for most of Latin America, part of the increase or accelerated economic growth has been a function of better macroeconomic policy. One of the lessons, I think, that's come out of the past 15 or 20 years, depending on where you're looking and all that, is that just changing the macro to a more stable situation by itself does help more than any of us thought earlier on. And that's certainly true in Latin America, that much of their accelerated growth has been on that account. It's also true, by the way, even in Africa. So that there is that part of it. Then there's the other part, which, as you said, is the pressure that comes from the appreciated exchange rate on the export interests. That's harder to handle, but there are a number of techniques that have been used or are being discussed, including sovereign wealth funds, things like that, that take some of the export earnings out of the current monetary base, et cetera, and therefore prevent the real appreciation, or don't prevent, but offset part of the real appreciation.
Yeah. I mean, are you saying that inflation is not really a problem in Latin America right now?
I'm saying that inflationary expectations still are a problem, which is why the appreciation of the currency, which is, of course, I mean, any country that has the kind of commodity price booms from overseas that has come into Latin America is going to face, obviously, an inflow of, so to speak, imported inflation. That's too much of a shorthand, but never mind. And then the question is, what do you do to offset it? Well, unless you do something, either by tightening monetary and fiscal or letting the exchange rate adjust, you're going to have more inflation. And in a sense, what's happened in Latin America so far has, I think, been reasonably good macroeconomic management overall.
You know, your question about the appreciation of exchange rate is exactly what we're talking about here, right? It's the other side of the coin, the dollar falling. That's the process that I'm describing in the charts that I just showed. In other words, that is what will cause the exports to the United States to shrink, and the slowing of growth is the appreciation of the exchange rate. That is the main mechanism through which monetary policy works in most of these countries, unlike in the United States, where it works primarily through, affecting consumption and housing and things like that. Mostly housing. In Latin America, in most of these countries, what happened, that is how the economy slows, is your currency appreciates and your net exports fall, and that's how the economy slows. So that is the thing they're facing, and it is a trade-off, as Anne mentioned. You have to do something if you want to reduce inflation. And I would say, and so, we have a different interpretation of the last 28 years. I mean, I would say when I look at this chart and I see really the worst and unprecedented economic growth failure in over a century, over a long period like that, I would say that overall the reforms failed terribly. They didn't fail completely. Some of the micro reforms that Anne mentions, you have telephone service in some countries, but overall some combination of those reforms, and I would say mostly the macro, failed so badly that you had this unbelievably long period of growth failure, and that is, to me, the driving force of the political changes that have taken place in Latin America. Now, Chile, it is true, is the one country in the entire hemisphere that grew faster since 1980 than before. But to me, this is just another way of demonstrating the failure. If you have an experiment in dozens of countries and it only works in one, then that's not a viable economic experiment. And again, I think there's plenty of room for debate on what failed. You had a whole series of changes. You had, tighter monetary and fiscal policies. You had, vast opening up to trade and investment flows, deregulations, labor market reforms, all kinds of reform, privatizations, massive privatizations all over the region. And you can argue about what worked and what didn't. I think one of the big problems is we haven't had that debate. We certainly haven't had it in Washington, and that's where the reforms really came from. So I think that what you're seeing, now, and you're going to see a very different response to this crisis. Now, again, you could argue, and I think the IMF, for example, would argue, well, it's because of the success of the past, and they can now do X, Y, or Z. But I think you're going to see different responses because you have countries now, you've had elections in how many, 8 countries, Argentina, Brazil, Venezuela, Bolivia, Uruguay, Nicaragua, Venezuela, where else? Not Paraguay. Where, all these candidates ran against what they called neoliberalism, these reforms that I just described. So they're looking for, new ways to make capitalism work. And that process is going to continue. And I don't, I think that the biggest part of it is going to be macro reform, and maybe some return to the idea of having a development strategy. Again, those were abandoned during the 90s idea of the government having a development strategy was pretty much abandoned. Its focus was on these micro reforms and these macro changes as well. So anyway, I think that's part of what we're looking at here over the intermediate to long run.
If I may, I agree with the macro reforms. I disagree that there's been so much reform on the micro side. There have been some, no doubt about it, and you mentioned a few of those, but overall, Latin America still has governments that or officials who by and large perceive themselves as regulators of the economy. I brought with me the rankings for 2007 done by the World Bank on the ease of doing business in various countries, which correlates with a lot. First countries in the world are Singapore, New Zealand, US in that order, even check it out. But interestingly, Argentina, 101 out of 170, ranked 101st out of 176 countries. Brazil, 121st out of 176 countries. On the micro side, this is the ease of doing business. It has to do with how many procedures it takes to get the license to do this, that, and the other, how many days it takes to get this, that, and the other done, how long it takes to take a case to court and get it settled, etc. And all the weights are in there. But the best country in Latin America is ranked 28th, which is Chile. Next best Mexico, among the big ones. I didn't pull in all the tiny islands, but I don't remember that they're ranking up there anyway. But very quickly, you get down to Uruguay, 64 out of, again, this 170. Colombia, 79. These are not. Venezuela, 164. So basically, these countries have not, as yet, what should I say, created an environment with property rights, etc., in a way that are conducive to the kind of private sector activity. And I don't think that, in my judgment, that didn't change as much during the 1990s. And there have been speeches by several finance ministers in Latin America, and Mexico in mind in particular, that have said as much. I don't think it's only a U.S. perception. The reforms have been there, there's no doubt, but it's kind of, you take off some of the worst, there's still a lot there that needs changing. So in that sense, I don't think that they failed so much as we got something out of it. We got better growth that was in there. The 60 to 80 period, you're right, was better than later on, there's no doubt. The 90s were disastrous years in many regards, partly for internal reasons, partly for external reasons. Things are a little bit better, but they are not as yet good, and they certainly aren't anything like threatening East Asian kinds of achievement ratios.
But despite that, Brazil continues to enjoy growth. And appears
much better than
decoupled.
Brazil's average inflation in the 1990s was on the order of 300% or something. It was huge. Brazil has macroeconomic stability. This is why they're so scared of going back to it, precisely because it's been some stuff on the macro side. The other thing that happened in the 90s, which didn't get much noticed and for which he did not get credit, is the president really pushed education. Brazil went from one of the worst educated at the primary and secondary level education, especially primary labor forces in the world probably, to not one of the best, but on the other hand, too much more. And those younger people are coming into the labor force now. And that does seem to have been having an effect on unit labor costs and things like that that are positive. So there's been something in the education system, in my judgment, is making a difference. There's plenty more to be done, however, particularly in the banking system, which you mentioned, the high real interest rate. The spreads between the borrowing and the lending rates in Brazil are incredible.
And it just sounds to me like you're suggesting that what they need is more liberalizing. That's what they're suffering from, though. That's why,
we disagree. That's
okay.
Not what they're suffering from. What they're suffering from is an absence of sufficient private economic activity of a kind that leads to greater employment, productivity growth, and greater output. And part of the reason, may I finish, please?
Go ahead.
And part of the reason for that is precisely, as I say, it takes, 200 and some days to get a license to start a business. It takes so long to do this and so long to do that. And so some of the big firms manage fine, but getting the new entrants in, which is, I think, increasingly recognized even by those who were earlier arguing it, is important. And the small and medium enterprises that are sort of out of which will come the next big successful companies, just aren't coming up as one would hope they would. Sorry.
That's fine. I think that's a good argument, and I'm willing to agree on the ease of doing business kind of reforms. I question whether that's the determining factor, though, after all these years of all these other reforms. I mean, and privatization is a micro reform too, by the way. It took place on a massive level. Privatizations were like 17 times the value of what happened when the Soviet Union went to, went from a completely state-owned economy to what it is today. So it was huge. I would like to see those numbers, like, what was South Korea when it was a developing country in terms of, now it's a high-income country, in terms of the ease of doing business, those same measures, I would bet they were pretty high. I bet India, which is growing quite fast right now, is also ranked pretty badly in that ranking.
India's been working hard, and those rankings have been improving.
But it's still not very good, I bet.
Well, it's not great, but I mean, some of the ones that matter, rule of law and property rights are good in India.
Yeah, but I don't think those things have the kind. I mean, I'm all for it. I'm for rule
Well,
of
from
law.
India, we saw that kind of stuff, and that's what slowed the change. I mean,
that was part of it. But
India never had the macro instability. India was always on the micro side.
Let me just make the argument that the macro policy is more important. Okay, let's look at Brazil for a second. Okay, you could have, let's say you got every micro reform you wanted in Brazil. Who is going to be able to borrow to start a business with 14% interest rates? Now, the only reason it hasn't destroyed the economy completely, I mean, imagine we had the Fed with 14% interest rates here in the United States, and our inflation rates. I mean, what kind of a recession, what kind of depression we would have there. Now, the main reason it hasn't destroyed the economy completely, besides the commodity boom, is that two reasons. One is you have the National Development Bank, which provides a huge amount of the credit to these companies at like 6 or 7%. So it's not as determinative, but it is. You're not going to have a mass housing industry with these kind of interest rates. So you had a period. I mean, look at Brazil. Big success story, but not in the last 25 years. They've averaged 0.5% per capita annual growth over the last 27 years, okay, about 1/2, maybe 6/10 now, if you throw in the last 3 years, okay? That's 27 years. Now, what did they do from 1960 to 80? 147% per capita growth, okay? And what were real, and you say they've always had high real interest rates. They didn't have high real interest rates during that period. Now, I'm just looking at one pound. I'm not saying that interest rates determine everything, because Brazil has actually adapted in some ways. They've adapted to, not very well, in the sense they still don't have any long period of sustained growth to look at. And this is a country that was a fast-growing country, a country that would be like Europe today if it had simply continued to grow at the rates that it did prior to 1980, which is what South Korea did, okay? And is like Europe today in terms of its living standards. So, some of these macro policies look terribly wrong, and when I look at it, I see, the monetary policy is really a huge one and likely to have more effect than the micro reforms that Anne is talking about.
Oh, they're both important. There's no doubt of that. But on the other hand, your numbers on Brazil obscure the fact that of that growth that you mentioned in per capita income, most of it, if not all of it, happened between 1967 and 1974, during which time they averaged 10% growth of real GDP per year, and those were the years in which they liberalized. And then when the oil price increase came in 73, part of the knee-jerk reaction was to put all the controls back in place, and that's when the rapid growth stopped. But yes, they got it, but it was that one period. They stagnated between 63 and the others. I know because I went there in 68 for the first time, and the first statistic you got was that per capita income had not increased.
Yeah, no, I realize it was concentrated mostly in that period, but not entirely. And secondly, I would say that what would really crash them after 1980 is more what crashed the whole region. And that's why I don't accept these arguments that, it was just import substitution, industrialization coming to an end.
Oh, I don't think it was only that.
Because what really happened after 1980, you had a huge external shock, and the region never really recovered, and I would argue it's because they adopted some set of policies, which we can argue over, that were wrong, and I don't think it was that, they continued to liberalize, after this. They got rid of the capital controls they had all the way into the 90s, and where did the boom come? You've only had 3 years, and even those last 3 years are not as good as what they used to have in the past. So clearly, some part of that set failed, and it seems to me more like, this is something that's very hard to prove econometrically, of course, but it's more likely to me that the macro policies and the abandonment of development strategies are the major failure, and not the fact that they reinstituted some controls for some part of that period after 1980. I mean, the whole continent went down the tubes after 1980. They didn't all do it. The only really common thing you could say is they adopted a certain set of those neoliberal reforms. And so I think it needs to be re-examined in a comprehensive way.
I'm just wondering what lesson the rest of the world takes from our subprime crisis. I mean, is it ease of doing business that led to lax borrowing standards? Is it ease of doing business that led to bad management of risk that has led to the Federal Reserve bailing out Bear Stearns? I mean, I'm just wondering what that index of ease of doing business, what it really means.
Well, it has much more to do with what I'll call the fundamentals. One of the things in it is access to credit, but by which they mean how long does it take to apply and stuff, not what the real interest rate is. But I mean, I think, first off, I think anything that we try and learn now from the subprime thing is going to be subject to re-examination over the next few years. I don't think we know enough yet to learn the final lessons. Some people are saying, of course, that all these potential borrowers were misled, but then others say, of course, they misreported and said they had income they didn't, et cetera, et cetera. So there's going to be a whole mess of stuff to sort out there, and it's going to be hard to say. The interesting thing, though, is in the midst of all this, there was a very interesting paper that came out about 2 years ago by Tornell and Westerman, in which they basically were saying who grows faster, the countries with financial crises or the ones without. And it came hands down the ones with, that yes, you got the boom, and yes, you had to back off it a bit. But a repressed financial system turns out to be worse even than a stable one. In fact, it may very well, I mean, obviously there were excesses in this one, but I don't think the lesson is to get such regulation that nothing will happen again, if you know what I'm saying. There's going to have to be some medium ground found, and I hope we don't overreact until we're sure what we're doing.
How much do you see Latin America being affected by tight credit conditions?
Well, the spreads, of course, have gone up on their outstanding debt to some extent, but with the higher commodity prices so far have more than offset it. So if you take the net impact of the commodity prices, world trade, and the increased spreads so far, it's very much on the side of improving conditions for them. If the spreads were to continue to go up and commodity prices fall, of course, you reverse the whole thing. And it varies a bit by country, too. Countries like Argentina have just sort of cleaned up the slate. By the way, one thing we haven't mentioned on Brazil, which is important both in terms of itself and because of how it makes policymakers, and especially top policymakers, politicians react, is of course the oil discoveries. And there's some risk from that.
And what about the new investment grade ratings?
Same thing.
That springs it all in and let it actually develop that.
Yeah. I think that I would worry more about these because not because of their direct effect, but because of the euphoria that comes with it and then the relaxation and so on.
Yeah, I think it's a mixed blessing too, because to the extent that the government thinks that, for example, they have to follow Goldman Sachs' recommendation and raise interest rates to 14.5% this year, the investment grade rating could end up slowing their economy further. If I could just answer one other thing which I think is relevant. Well, in answer to Will's question, what lesson should countries or world countries take from the U.S. Crisis? I mean, there is the question of the market fundamentalism and regulation, and I don't have a huge. I actually don't think that you need massive re-regulation. Mostly it's rules that weren't followed in the first place. But there's two lessons that I think are really important. One is this is the second asset bubble that we've had that has burst and caused a recession. So clearly, the view that Alan Greenspan and Ben Bernanke have expressed that the Fed and policymakers in general don't have to pay attention to asset bubbles, I think is going to be determined to be wrong. And that doesn't mean, by the way, they've gotten off easy because people ask them should they raise interest rates in response to an asset bubble, and the answer to me is no. All they really have to do is kind of do what CEPR did, only with a bigger megaphone, which they have, which is just explain to people what the bubble is. People were buying homes because they thought they only went up one direction. And the same was true through the stock market bubble, and I'm quite sure from Greenspan's writings that he understood both of those bubbles, but chose not to say anything. So that's one thing I think, that's the most important lesson to learn. But it's not a subprime crisis primarily. It's a housing crash, okay? The prime lending market as well is crashing. And so these were asset bubbles, speculative bubbles, that can be prevented simply by policymakers informing the public of what is going on. And the second thing which is a more complicated lesson and that nobody seems to have noticed, but I'm sure, quite possible Anne will agree with me on this, is that if you look at why the United States economy fundamentally was so dependent on these asset-driven consumer spending bubbles in the past 15 years, I would say it was because the United States simply was not competitive internationally at the exchange rate that we had. In other words, we had an overvalued currency for most of the last 15 years or so. And, you know, in most of the world, this is well recognized that the exchange rate is a very important policy variable. China, Japan, Malaysia, Argentina, for example. All of these countries, I think, recognize. Here you have this kind of idea that the stronger your currency is, the better off you are. And in fact, when you have an overvalued currency, you run chronic trade deficits, and something has to compensate for it. In our case, we had these asset bubbles and unsustainable spending and consumer spending and unsustainably low savings rate and everything else that went with it. I would say the fundamental imbalance is, in fact, in the exchange rate. That's what's correcting now, and I think we will have a very different U.S. economy if it adjusts to a reasonable level.
Well, we partly agree and partly disagree. Asset bubbles caused recession. I'm not so sure. Quite clearly, had they taken actions which earlier on discouraged things sufficiently, you might have just had the recession earlier. So there's that kind of consideration.
Less deep.
Well, that's possible, but perhaps longer, who knows. But the more important thing is, what about the exchange rate imbalance? You cited Japan, and the Japanese had tried to intervene in their exchange rate and finally gave up because they discovered that it was an inefficient and ineffective policy variable. You cited Argentina, which is not exactly a paragon of economic policy, and in fact I think you could argue is going to be paying in the future for some of the mistakes, including the exchange rate right now. And other countries have found that that's not the way to do it. Why was the exchange rate, as you call it, overvalued in the 1990s? Because the U.S. economy, and some of your own writings say so, was one of the most productive places in the world to invest, precisely because Europe had a growth deficit of major proportions. Japan was in recession, so the U.S. and the other Anglo-Saxon countries in the Nordics were about the only ones carrying the world economy. And that then led to them being very profitable relative to these others. And so you got capital inflows.
Bubble inflows, too.
No, I think the bubbles came, I mean, the bubble happened, and it may have happened because in part that was enabling, but that was not the same statement at all. I mean, the interesting thing is that consumer debt had, I think it was 30% of consumer income in 1960, if my memory is correct. And it is, every time there's been something, people said, oh, it can't go up any higher, and it has sort of secularly gone up as consumer borrowing has increased. And I think it's now well over 100%.
But there is a limit.
Well, yeah, but I mean, every time but that was said when it was 30% too. And you know, it's an interesting question what it is and how much that had to do with whatever. And as I said, I just don't think we've learned all the lessons yet. I don't believe the information yet to know how much was what in all of this. You say, well, it wasn't the subprime. Clearly, it wasn't only the subprime. Clearly, other things entered in. But on the other hand, in terms of where things started and where you got the, shall I say, change of expectations that turned things around, it was quite clearly the default rate or the non-performing loan rate among those first.
I don't agree. If you look at our papers on the housing bubble, you'll see, I mean, from 1950, or you can even go back further, all the way to 1996, home prices nationally did not increase above the rate of inflation. And then from 1996 on, it went like that, 70% above the rate of inflation. So this was a bubble, and it was in the entire housing market, and it's blowing up in the entire housing market. The term subprime crisis is actually a misnomer, just like the stock market bubble was often referred to as a tech bubble.
Well, it's certainly true that as housing prices have gone down, people outside the subprime range have also been walking away from mortgages when they're underwater.
But it's not just a walking away problem. I'm just saying, that 70% increase is just a bubble. That is bubble growth in the entire market. That's the result of speculation, or, well, not just speculation, but people expecting house prices to go only in one direction, and that feeding upon itself. And that is something that has to return somewhere close to trend. So it's in the entire housing market. Now, it's very different, and we have several papers on this. It's very different by geographical area, of course.
Yes.
I'm giving you national averages, but nonetheless, that is a speculative bubble, and the subprime lending was just one part of it.
I'm just curious if you could help put in context how high the commodity prices are in Latin America now, sort of in compared with recent history, and where you expect that to go in the future.
Yeah, well, they are much higher. I don't have the numbers right here. I mean, I can tell you, how much, soy and, for example, wheat,
Oil.
Oil is, we know those numbers.
Copper is 4 times what it was. Wheat, as you know, is up.
Is record high? I mean, these are
Many of them are close to it. Again, it depends on what you adjust. And of course, the commodity composition differs by country. Venezuela, with almost nothing but oil, looks very high. Argentina looks very, very good. Chile's copper. So it really depends a little bit on the commodity mix. You can get the number for the average terms of trade out of the latest World Economic Outlook. I looked at it yesterday, and my memory is for Latin America as a whole, the terms of trade, which is not quite the same thing as what happened. The commodities are up about 40%, which is huge. But that's my memory, so.
And it's driven by the commodities, even though it's not all commodities.
Oh, I agree, but I mean, no, I think the commodity thing is even bigger.
Yeah, that's right.
That's what I'm
That's
saying,
right.
and that's an average overall, but check the number, but the World Economic Outlook has it.
But it is a tough call, I think, as you said at the beginning, how much of that is speculative, how much will come down in a recession. I think that's very hard to tell at this point.
Don't you think as long as you've got that demand, I think you were saying, as long as you've got that demand going in China and anywhere else, I mean, I guess Latin America just, continue and increase exports.
But, not all of Latin America's growth is driven by this, in the last few years, is driven by commodities either. I mean, if you look at, Argentina, for example, they had very high growth for, it's 6 years now, since the second quarter of 2002.
And it took them until 2004 to get back to their 1998 level.
Yeah, but very little of that growth is really commodities.
Well, that wasn't growth, that was
first
bounce
6
back.
months was, well, it's not all bounce back after they passed the 2004.
I said until 2004.
Yeah, but now they've had 4 years since then, and I actually do think that their exchange rate policy was maintaining a stable, competitive real exchange rate was important, and it's a heterodox policy, but I think it was an important part of that recovery. But that said, it was not a commodity-driven economic recovery, as often reported in the press. The first 6 months of that recovery was really the only period that was really where net exports were the bulk of or even a large part of the economic growth.
Which was when the exchange rate had been permitted to change.
Yeah.
Surely it's the diversification of demand has allowed countries like Brazil to continue with the growth rates they have, even though the U.S. demand is falling off from the
Well,
U.S.
as
It
you
wasn't
saw-
for demand from China and elsewhere.
Yeah, and as you saw in the chart, they're very little. Brazil has very little. South America as a whole, I think, is only 15 to 20% of their exports going to the U.S., whereas Mexico is, 77% of their non-oil exports to the U.S. and Central America, Caribbean. So it's okay.
I'm sorry, I'm going to have to go.
We can pretty much wrap it up. If you have more questions, it's okay.
The thing you hear all the time about Latin America is that it's in danger of becoming so insignificant. That it's just that people are just look so much at Asia now. I mean, Africa's is one next kind of horizon. I mean, do you get that kind of sense at all?
Well, there's no doubt that its relative importance in the world economy has diminished. I mean, and at current growth rates and current growth prospects will continue to. I mean, there was a time when East Asia was the low man on the totem pole, and of course that's changed with their high growth. And then of course South Asia's come into the equation there. So that's right, as you said, Africa's doing better. Well, as those countries become, or those regions become relatively more important, somebody becomes less, and at the moment, that is partly, or not significantly, Latin America. So it's not irrelevant, but it's not a driver in any sense in the same way that East Asian growth and so on has become.
Right.
No, I
But
agree.
the Bovespa must be one of the bright sparks of the kind of global economic landscape. I mean, the Sao Paulo Stock Exchange, if anybody invested in that must be very happy.
Yeah, but Brazilian growth is still only
The
between
stock
4 to
exchange is
5%.
a pretty small part of these economies, very small. And this is the story. I mean, when they overcome that, when they actually get, if they ever reach Asian level growth rates or something close to that, which is no reason why they shouldn't be able to, really. Then they'll increase much more in their economic importance. Yeah, I think that's the main thing. You know, it's funny because the media kind of focuses on things that are most relevant to investors. So the countries that have a bond market, for example, get 10 times more coverage than the ones that
Well,
don't.
that's what we do daily, stock market reports.
Yeah. But I think
For
that
people sitting in New York,
the relative importance of the economy really depends on overall growth.
No, Brazil is half of Latin America's economy, so.
Yeah, exactly. Is it true that this new oil find is something like the biggest in?
I don't think they know yet. I
They
mean,
don't know yet.
the different people are giving different estimates.
Yeah, I know.
And there's a lot more exploration to be done.
But it's sizable.
Yeah.
It'll make a difference.
Well, they've got to get the investment in though, and apparently there's some regulations that need changing.
Changing very quickly.
It's very deep, right? I mean, it's a
Yeah.
difficult
And there's
location.
Big rock formation.
Yeah.
Well, thank you. This has been really helpful and interesting.
Thanks for coming.
Yeah.